which company or which customer is on a more sustainable path. What's the emissions versus pound profit versus number of employees, etc. Instead of credit risk aspects, it's that sustainability variables that we're bringing through.
As an industry, we've been building objective, data-driven scorecards for, 40 years now? Maybe 60? I should actually know because the very first episode of this podcast is a history of credit lesson with Raymond Anderson, but let's just say a long time now, and we've built up a number of valuable skills and learnings along the way. And now that everything is data, we can apply those skills to answer different questions. And one of the questions that keeps coming up is, how do we measure green credentials? Or if you like, how can we build a green credit score? Welcome to How to Lend Money to Strangers with Brendan LaGrange. Daniel Mclean, client partner at Foremost. Welcome to the show.
Thank you, Brendan.
Daniel, Foremost offers specialist credit risk, market risk, data, and actuarial solutions, all bespoke and all developed by world-class experts. It's a sort of company that I think is very well known in certain sectors, but outside of those, maybe not as well known. So before we get into the meat of the discussion, would you mind filling us in on who Foremost is and what sort of work you're doing?
We're an analytics consultancy born from credit risk, but we've expanded into other areas. Predominantly is focused on banking and finance lending, so the development of models in IRB, IFRS 9, but also strategies for application portfolio management for banks and financial lenders. We also work on the validation of those models and then model risk management. So that's kind of been our core area of focus. That's what we're originally known for and probably still best known for. But yeah, we are expanding out. So a few years ago, we launched our insurance practice and recently expanded out into a data practice, which is going really well, supporting clients with data governance, BCBS 239. Today, we've worked with over 80 different clients, touching on all points of the globe. The team itself is 300 specialist consultants, and they've come from working from tier one lenders, regional building society, monoline credit providers, and a range of expertise, so ex-CROs, risk directors, decision science leads, to recent graduates. We originally had an office in London. We expanded that into a satellite office in Leeds, recently opened an office in Dublin. At the end of last year, we opened one in Dubai, and a couple of years before that, we opened an office in Bangalore as well. So from when we were founded in 2011, we've really been on kind of an exponential growth to where we are today.
Yeah, that really is impressive growth. And you've obviously been there for quite a big part of that. You've been at Foremost for about 8 years now after a similar time in industry. So do you want to talk a little bit about the work you're doing for Foremost and maybe the career path that brought you to there in the first place?
Yeah, certainly. So as you mentioned, I joined Foremost about 8 years ago. I first started having conversations with Foremost a couple of years before that. Rob McDowell, who's actually our current CEO of the company, I previously worked with him in credit risk. So I had the relationship. A year down the line, I got another call from him just to see if I'd be up for going for a meal and just have a catch up. And then he kind of told me the plans for Foremost, the ideas and kind of the work that we're currently in. And it was really interesting. Since joining Foremost, I've worked on lots of different projects. So working on regulatory, non-regulatory modelling for secured portfolios, retail portfolios, corporate and commercial. So it was really, when I sat down having that dinner, it was kind of the breadth of work that it was telling that I'd be able to do. And that's really what swung it for me. And I think that's the opportunity to keep developing and keep learning and current interesting work.
Yeah, and speaking of sort of current and interesting work, you were recently recognized in the UAE's green initiatives for a green credit score. You hear a lot of people talking about it. You hear a lot of people asking questions about it. But you don't often hear people answering those questions and really putting out a product that fits in that ESG space. So set the scene first for us. This green credit score, what does it look like? What's it doing? And how did it end up being so well received in the UAE?
The project itself kicked up a few years ago in the UK, so it was supported by the innovative UK Small Business Research Initiative, and we were effectively looking to bring something to market that helps categorise kind of sustainability via ESG for lenders. The market itself is new, so the supervisory statement SS319 was released back in 2009, which kind of give the overview of how lenders should start to think about climate risk in terms of the strategy, the governance, the disclosures, etc. And what we effectively were looking to do is how can we bring something to market using the skills that we have, the knowledge that we have to be able to support lenders being able to implement this and manage their portfolios. The scorecard itself, it looks and feels like a traditional scorecard that people will be used to seeing. So you'll have a number of variables, they will have points associated, they will aggregate up, and then you will get a score. It's a structured process to try and enable SME experts within an institution. So you'll see that there's lots of ESG scores out there that can be black box. A company will be given a score, but you don't necessarily know the inklings behind it. What we bring in with our green score is effectively that transparency, bringing in SME climate experts for an institution and try to build that score around what their views are and how they view it and align it to their pathway to net zero or ESG or climate risk within their institution.
Yeah, because I think that's what's been missing. And as I said, I'm no expert. I'm sure there are other models out in the market that do take that sort of very structured and transparent approach. But from the outside, it feels like that's been missing. That credit scoring expertise, that mindset, I think is that step in bringing it to a place we can measure and manage much better going forward. I see in building it, you've also created an approach you call the knowledge elicitation process. What does that mean?
One of the beauties of working for Foremost is that lots of investment that goes into internal development and research. So the knowledge elicitation process was effectively a process that was built for low default portfolios. So obviously the key for modelling is being able to model against something, which typically in the credit industry is an account going into default.
Yeah.
What the knowledge elicitation process does, when you don't have that information, it effectively allows to bring the characteristics that a customer may have, and it allows the experts within this institution to be able to look at a comparison between those two and effectively give what the probability of one account going bad is versus the other. You do kind of a paired view over a number of maybe 150 different customers' profiles, and effectively that brings you almost a synthetic data set, which you can then use to do more of your traditional modelling. Rather than people kind of thinking this one's better than that one, you're structuring it into a model and you're able to implement that quite easily into a BAU or day-to-day process.
Yeah, we spoke about sort of the input or the build process being inspired or built upon your knowledge from credit scoring. In terms of the output, what sort of score is this? Is this a measurement score that tells us how well we're doing, or is there an element of predicting in there?
It's that predicting element, similar to look for getting that expert judgment and see what the probability of that account going into default versus another one or going bad versus another one. The idea is to look at the information and say which company or which customer is on a more sustainable path. So what we'll try to do is bring that information through. So it might be scope emissions that we've been able to calculate through annual disclosures, or it might be something via a third party to be able to bring in that information. We can then obviously then calculate some intensity metrics over the back of it. So what's the emissions versus pound profit versus number of employees, etc. We can ask questionnaires to customers on annual reviews to try and understand what's their plans on being a more sustainable business going forward. Do they have any? Instead of credit risk aspects, it's that sustainability variables that we're bringing through. And then again, it's using those expert judgments to view what do we think is a more sustainable company, which one do we think is more on that path going forward. And that allows you to then obviously rank that information, and then you can then use that on a going forward basis to understand it. The advantage that it's got is obviously you can run this across your full portfolio, and you can start to try and tailor it to what your path is, what your goals are, what your risk appetite is in that area to understand the business profile and how that's going to merge and potentially where any concentration risks are in the portfolios, or where you maybe need to speak to some of the lenders to understand maybe they need to review their plans for you to continue effective lending with those. The idea is that it tackles a number of different areas that align to sustainability. So we spoke about emissions and emissions intensities, but also what are a company's plans to be able to manage a transition to net zero or be more sustainable. So typical questions that you might look to ask the company to answer is the management attitudes towards adapting a business model for a transition to a low carbon economy. And do you think those are achievable as well? Is there a plan in place to how they can manage that? Whether the business is already implementing green activities and taking into consideration climate risks. So if we've got an automotive kind of company, are they looking to invest in EVs? Are they still working on carbon combustion engines? Those questions can be different across different sectors. So ones that are potentially more vulnerable to climate change, such as agriculture, construction.
And who's answering those questions? So if I'm the lender and I've got a portfolio of 1,000 SMEs, am I sampling from those SMEs and then having them answer the question, or do I answer it on their behalf?
Ideally, so on annual reviews, we would have the structured questionnaire through, and we would get information that's publicly available. We would get through, so we might be able to look at annual reports to understand if they've got any kind of sustainability plans, sustainability goals, scope emissions, etc. But yeah, any kind of gaps that could be addressed through questionnaires. And ideally, you kind of tie it with that annual review. And there is their expectation from the PRA that lenders are having these conversations with their clients and their customers.
Yeah, you can envisage a world where, like we have the credit bureaus, essentially you could have these comparative metrics across an industry and through industry, so we can start to really understand who's doing well. On the outside, often you would ignore things that don't affect you, but climate goals and kind of the wish that we all move in more sustainable directions means that this is a score that is of interest to everybody. So really fascinating to see where that goes to. Talk to me about the implementation side of it, the take-up side of it.
It is new to market, so we are going out to speak to lenders now about kind of implementing this. I think as the market becomes more aware and looking to implement solutions in this space, I think it's become more obvious to lenders where they can use it and how they can use it. But as you can see, it's almost regional agnostic to how it can be done, born from the UK, awarded in the UAE.
Yeah, and Daniel, I got two questions in terms of people who maybe want to learn more. First is, you mentioned here that we can implement it at a portfolio level. Who should be engaging with you? Is it normally a specialist sustainability department from a lender? Or is this something that, a normal lending department could start talking about and understanding? And second, link to that, if they want to learn more about this, who or how should they get a hold of Foremost?
For those lenders that are focusing on the SME lending in that area, that are looking to set targets and understand how they can make that portfolio sustainable or how sustainable that portfolio is, I think that's the key market for it and the key area that it would be able to support lenders today.
When they see that score, is that score then applicable to their portfolio, or does it drill down to the customers? Can they even pass some of that on to the borrowers within their portfolio that they might see X or Y SME is doing a great job?
They could pass that information on to the customer. So the idea is obviously you would score not necessarily portfolio, but it'd be those customers within that portfolio, and you could get a kind of maybe an average view, which would be understand how that portfolio is, and then you might be able to set targets off that of actually we think this isn't a necessarily sustainable portfolio. How do we then manage that through? And then you can use a scorecard for when new applicants are coming through, or are you doing those annual assessments? If you're then setting your targets on how you want to kind of achieve a more sustainable, longer-term portfolio, you've got that rating system which effectively allows you to review customers not just from a credit risk aspect, but also from that sustainability aspect, and feed that through into the decisions and maybe the lenders you're doing.
You'll see stories in the paper that X or Y big bank is being pressured to stop financing fossil fuels. And that's about the level at which we can really talk about it. Is, we can see big bank A is lending to big oil producer B, or is financing new oil exploration here or there. And we can pressure them not to do a $10 billion deal. But everything under that is essentially invisible. It's invisible to us as customers and stakeholders. It's also probably invisible to them. But all of a sudden, we have this tool that can understand the same forces all the way through down to small businesses. They've got something more than just saying, we don't lend for oil exploration. They can now actually say, hey, we give better deals to more sustainable companies. We do this on the positive side. We're avoiding X or Y in the subsectors that we maybe don't talk about, which suddenly allows you to really back up the talk. So instead of ESG being this thing that happens in the financial reports and you've turned the page and carry on. It actually becomes a lever for strategy. And I think that is going to be exciting, yes, for people in the ESG teams.
Certainly, and I think it is bringing that theoretical view of ESG and like you say, those broad brush rules that people might implement to try and bring it more into that day-to-day view and the day-to-day lending and have achievable targets and kind of show how you're managing that through, and then the conversations relationship managers can have with the companies that they're lending to and how they look versus their portfolio and what things they might be able to do.
And so, yeah, if anyone listening, I guess essentially in any market, is interested in seeing this and how it works, getting closer to the details, how do they get in contact with Foremost? Is that the for-most.co.uk website?
Yeah. So they can come through the website. So we've got an email for Foremost, and then reach out to me direct. I'll be happy to have the conversations with anyone.
Perfect. So I'll put links to you on LinkedIn and things in the show notes as well. But yeah, the roots of Foremost are in credit risk, and that's kind of where most of the audience to the show lives. I was having a look at that for-most.co.uk website last night, looking at some of the articles you've got up there. And I saw you've published one recently on the current state of affairs in terms of IRB, talking about whether the PIT approach, which I've only just learned is point in time, probably an episode on its own, but what was that article about, and what are your thoughts within this sort of very changing world we're in, where we're standing in terms of IRB modelling?
This is predominantly focused in the UK, so it was a consultation paper released at the beginning of 2023, which was looking for the implementation of the Basel 3.1 or Basel 3.4, as some might call it, and the new regulations. The industry itself has just gone through a very rocky path. Traditionally, IRB rating systems have been a point in time or through the cycle methodologies. The aim is then to move towards kind of this hybrid approach, which is what the secured world has been going through over the last 2-3 years in the UK. As I mentioned, it's been a rocky path. Lenders are starting to see the light at the end of the tunnel as focus starts to move away from on the secured world with those hybrid PD submissions. The focus has obviously then moved on to kind of the unsecured portfolios. If we go back to what a rating system is, so through the cycle effectively it kind of assumes 0% cyclicality. So the risk weights that are used to define capital requirements are not really influenced by customer behaviour or economic change. It's typically through the risk appetite of a bank. Whereas a point-in-time rating system is pretty much 100% cyclical, and it's measuring those accounts, there's expected default performance of accounts in the next 12 months. During downturns, the capital requirements going up, and in the good times, that is going down. And the way that lenders would typically do is to apply the capital, they would have a point-in-time plus buffer approach or a point-in-time variable scalar. And that effectively just adds a little bit of contingency onto that PD to make sure that they're adequately capitalised at any time. In the consultation paper last year, the PRA effectively outlawed the use of a variable scalar, which then the client to, does that mean that point-in-time approach is still applicable? Can you still do that point-in-time approach, or can you do a long-run similar hybrid type approach to building models? When you're looking to do this unsecured data over a longer economic cycle, if you think about how unsecured products have kind of changed even over the recent years, but over the longer term, so credit card balance transfers, money transfers, buy now, pay later, it's quite easy to be arguable that actually an unsecured product doesn't necessarily look the same today as it does historically, so you might not have that representative sample. So therefore, I think that does potentially leave the option open for a point-in-time buffer approach. From a modelling perspective, it's certainly easier and simpler to build a point in time, easier to manage, easier to validate through. So I think there is pros and cons. In the article you mentioned, that pretty much just covers up what those pros and cons. It's very much a theoretical piece. So the results of that consultation paper are not due out till the end of Q2 this year, which is obviously very much coming upon us. But lenders are starting to kind of pull that data together to be able to make sure they are compliant for when the regulations come in. So it was a response to questions we were getting.
Yeah, well, I think it's pros and cons, no matter what way the regulator goes, to be thinking through what these implications are from the different approaches and internally kind of what makes more sense. I think just in general that idea of the history of unsecured lending is something we need to deal with in every model we build and in every strategy we create going forward. how applicable is that history? New products have entered the market. There's debit and credit and where spend is going. There's also obviously COVID and huge changes in interest rates and cost of living. We really need to be careful when we build a model, we build any strategy based on the past, that we've got a good sense of how we are taking that into account. Yeah, that article is on the website, as are many more. I saw just like a real wealth of posts coming out across that new expanded span of Foremost's work. But I also saw their in-person quarterly economic updates, so in London and in Leeds.
Yeah, so certainly, so the economic forums that we have, Keith Church, our head economist, he runs us too. So it's a quality base, and it's just to give a view to our clients, but lenders that aren't our clients as well. What we think is going to be happening over the quarter. How did that look versus what we had in the previous quarter? But it's really good as well, just as you said, get those face-to-face meetings in gathering, so people in the industry can kind of just come and have a chat, share views, share opinions, and even just get to see old colleagues that they potentially haven't seen for a while. The way that we work with clients is we don't just come in to kind of just deliver a solution and then just leave. Knowledge sharing is kind of one of our key elements. So I've recently started a project myself, which is working for a client that is focused on the commercial space, but they're looking into the consumer space, and they're asking lots of questions of how can we train up, how can we get the knowledge of in this area. And I was like, well, through this project, one of our key goals will be to make sure that we're bringing you along with that journey. You're understanding what we're doing, why we're doing it. You're inputting into some of those key decisions as well. So we're not just making those decisions for you, so that when it comes to the end of that, you should be able to understand what we're delivering, the models that we've delivered. And then again, you should be able to implement and make any changes in-house yourself going forward.
Yeah, there's some consultant firms that were worse at this than others, but they're the bad old days when companies were known for trying to just continuously keep their hours billed. But as a consultant, you want to have your next project building on the first one. You want to be doing something new and expanded. And if you are not bringing the company along with you, next time, even if they are engaging you in 2 years, it'll be to do the same work over. And, that's not great for the team. So, yeah, I've been a big fan of Foremost. It's been a great pleasure to have you on and to learn about this green credit score in particular. It's a tool that allows us to really make big strides, a start of something that I can see becoming very big and very interesting.
Yeah, that's what we're certainly hoping for.
And, yeah, very happy to have had a chance to speak to you today.
Yeah, you too. Thanks, Brendan. Thanks for the time.
And thank you all for listening. Please do look for and follow the show on your favorite podcast platform, and share the updates widely on LinkedIn, where lending nerds are found in our largest concentration. Plus, send me a connection request while you're there. This show is written and recorded by myself, Brendan Lagrange, in Brighton, England. Show music is by I Am Wake, and you can find show notes and written transcripts at www.howtolendmoneytostrangers.show, or just www.htlmts.show, and I'll see you again next Thursday.